Hello and welcome to Gamma On, a new limited series all about taking your trading game to the second derivative. We'll explore how the rise of options trading has created powerful new inputs for traders who understand the feedback mechanism between derivatives and their underlying. I'm Oliver Renick, lead anchor of the Schwab Network, and helping kick things off with me for the first episode is my friend and colleague, Shane Skinner, a manager on the institutional trading team at Charles Schwab. Welcome. Good to have you here. Tell us firstly about kind of where your background stems from and what you do on the trader side. And give me your first, your full title, which is kind of a long one.
Yeah, so new title since a recent promotion is Manager AS Trading Services System Support.
Wow.
Basically means I back up the execution desk for the institutional side, so advisors that place large block orders on options. I back those guys up, and then I work primarily on assisting with the trading software that the advisors use on the institutional side. Very similar to Thinkorswim. It's called ThinkPipes, but it's a phenomenal role. I'm loving it. I'm getting to see a completely different side of the market.
A bigger side, right? These are bigger traders. You were on the retail side prior, doing similar things, but for smaller clients.
Yeah. So, retail side for about 3 years, did do a couple of months at a prop firm in the board of trade as well. So I got to peek behind that curtain also. But yes, retail side, trading 5 to 15, contracts a trade mainly. Here on the institutional side, we see more like 500 to 5,000 contracts a trade.
Yeah.
So the size has definitely amplified, and it's become very interesting seeing the way retail traders utilize options, either speculatively or managing their positions by hedging, and then seeing how advisors, more institutional level traders, manage their positionings via options.
Everyone now kind of has to navigate a different type of world in trading that has pretty clear implications from the rise of options as the kind of preferred instrument to trade for a lot of folks. And that's where this series is going to kind of find its roots, which is in those second derivative concepts that go just kind of beyond things like delta. We're going to talk gamma because a lot of people, that's where they start in kind of analyzing how options trading adds this other layer of sort of convexity into markets on top of the sort of traditional way we think about using spreads and think about volatilities. And all of those are kind of the level one sort of entry points to understanding the options influence on markets. But now you have this kind of other layer on top of it that we talk about a lot on the show, and we look at options flows, we look at dealer positioning, the role of market makers, and how big players in the market tend to overlap with important levels, and that kind of feedback mechanism there is that some people describe as sort of the tail wagging the dog in a way, but they all sort of live fairly harmoniously. So we want to try and get through some of these concepts that at first are maybe a little bit overwhelming or challenging, different terminology. So I think we set kind of the baseline here for what the terms are we're using. Gamma on, because gamma is sort of the introduction to the second derivative, where the first derivative is being delta as an example. If we kind of start there, when you learned about options, this is how much the options contract is moving based on the underlying. That's kind of your first derivative. So when you start there, kind of take me through the process of one, how you calculate gamma, and then two, that kind of suite of second derivative functions.
Yeah. So, right out the gate, like you said, delta's the first one we look at, simply just amount. An options price changes for $1 change in the underlying. And then you get into, next up, we'll skip gamma for a second, come back. We'll go theta, right? There's time decay effect on the value of an option. We've got vega, which tells us for 1% change in implied vol, what happens to the option. And then there is rho. Let's not forget about that. It kind of seemed irrelevant for years, and then as interest rates started to come back into play, rho is one to keep an eye on as well. But
good point. Yeah.
Main focus being on gamma, which is the rate of change in
Right.
delta for every dollar change in the underlying. So it's just the delta of delta, essentially.
Which is a great place to start to kind of knock out the basics here, because the first derivative functions you listed there from delta, theta, rho,
yeah.
and what did I miss?
Vega.
Vega.
Yep.
So those are all on the same plane. And then you have the derivative of those starting with delta, which is now that second plane basically where you're in the second derivative realm.
Yep, gamma, exactly. There are a couple other ones that maybe down the road we'll get into, like Charm
Right.
and Vena. I know we have some guests on the network that will love to talk about that stuff as
Yeah,
well.
and kind of a first initial shout out to Jem Carson, who kind of popularized a lot
Yeah.
of these concepts. But a lot of folks that have been thinking about this and trading this for a very long time, yourself included, Kevin Green thinks about this a lot, Alex Coffey as well. So that's kind of our little suite of folks who are going to be joining us here throughout this, and we're going to also be talking to professional traders who, do use this as sort of one of their either major tools in the belt or the starting point. For me, it's kind of been a tool added into the belt, whereas from your perspective, from a trader's perspective, from what I understand, that's kind of like at least that's kind of how we first started talking about this stuff, because you've always thought about these things from kind of the onset of your trading career.
Absolutely. It's become sort of this analyzing the gamma levels and the gamma exposure has sort of become my main technical. Now, I use other technicals. I look at micro and macro. I look at fundamentals, right? This isn't one of those things that's the end-all, be-all, but at the same time, what's so fascinating about this specific technical is it is accounting for positioning and options in real time and the effect that that positioning has on not just, the retail trader, but market makers, institutions, and it's sort of this conglomerate of the relationship between everybody participating in the market and the function and sort of behavior that the market has to follow based on everybody putting money in one direction or another and at certain levels. And so what we're talking about isn't, it's not a momentum study. It's not a moving average. We're talking about real money being on the line at certain price levels.
Yep.
And we see that some price levels have large amounts of money on the line at them. And so just logically thinking, without even really going too deep into it,
That's what matters.
one would think, yes, that's going to matter. And so
it matters even more, and the reason why I think it's become popularized is because of this massive rise in options trading, volumes, education, COVID in particular also. It's important to also kind of give shout outs to some of the big trades that also people associate these concepts with, which was kind of going back to some of the meme stock frenzy.
Yeah, gamma squeezes.
Some of the ability for everyday folks and retail traders to understand kind of where some of these big vortexes of energy are in the market. And if you're able to, in the event, kind of ride those waves right as they break, they can lead to big moves, because if you know where there's a lot of money positioned, we can also generally conclude that those who are in those positions will react a certain way based on how price moves, assuming they're acting in their best interest, which then would be to either cover their positions or take profits, etc. So that's kind of where none of this is like science, right? With art, which is markets basically, it's kind of a hybrid between the two. The science is that, look, the numbers are pretty straightforward. You can see where all the contracts are. You can derive then the implications for things like delta, and then by consequence things like gamma. Now, of course, we never know where price is going to go, but the logic follows naturally. If price comes up against these areas, there are a few ways for us to think about trading them.
Liquidity, right? We flow to liquidity. If there's no liquidity at a certain level, but there is at another, chances are you're gonna go where the money's at, where the liquidity's at, right? So I think you nailed it in terms of we have seen a major shift since COVID in terms of retail trading has exploded, and the accessibility for retail traders to utilize advanced trading software, stuff like Thinkorswim, and there are other things out there, right? There are other brokers and tools that people use, but in reality, I could trade from my smartphone now.
Yeah.
So if I can do that, anybody can do that, and so access to markets is at the highest it's ever been.
Yep, education too.
Absolutely. And then on top of that, we're seeing that since the inception of zero DTE options in indexes, these zero-day index options, based on a study from the CBOE looking back at August of 2023, that month, 50% of all SPX option volume came from zero DTE options.
Yeah, wow.
And you're seeing a lot, we've mentioned it on the network before, you're seeing a lot of options trading in the front end, meaning either today's expiration at the index level or Friday's expiration for something like Tesla or Nvidia.
Dailies,
Weeklies,
more
right?
active trading.
Short-term front end. And that is newer.
Sure.
Not that it's not been going on prior to, but at the level that it's going on now, it's greater than it was prior. That's having an impact on the market. So,
and that's why we basically do these options flow hits.
yeah, it's
day.
worth looking
You've been
at
on
that.
Market on Close, Kevin Green, generally his forte, and that's where on a daily basis it makes sense to look at these things. Give me some more stats on, I know you got some stuff on the kind of rise of options in general for, those who are just waking up after a 5-year slumber. I think everybody kind of knows most of the options volumes and participation is going up and to the right, but how big?
I mean, so it's funny. Ever since this started, the market's been trending higher, right? Since COVID, we did have a big of a pullback in 2022, but overall, market's been doing phenomenally.
Right.
And at the same time, we've seen heightened market volatility with this increase in options trading. It doesn't mean the market hasn't been trending higher still, but you've seen it. There's been a lot of chop that hasn't really been normal prior to this environment we find ourselves in now. That creates both risks and opportunities for traders, right? And so, a CBOE study found that the trading volume, zero DTE options, is directly linked to, surges in S&P 500 volatility.
This is coming from SIBO.
SIBO, yes. And so basically, the blame for exacerbated intraday volatility in the indexes is basically being tied to the hedging activities of both market makers and fund managers, institutional players, big money, no matter what side they're
Which
on.
can kind of take different forms, but
Correct. You're getting all these different angles that big money comes from, but really what we're seeing is that since the invention of these zero DTEs, I mean, it was probably 2 or 3 months back, we saw there was, in the last 20 minutes of the day, SPX went up like 60 points in 20 minutes. That's
pretty sharp move.
a pretty sharp move, and that's stemming from what we believe to be the options activity.
I got some more stats from Henry Schwartz at SIBO. The 2024 combined average daily volume so far, 48.6 million. To give perspective, back in 2015, that was like 15 million. You see a big jump in single stock options alongside ETF options in 2020 around COVID to our discussion, with 2021 being the single stock options high. Right now it's at about 25 million so far in the fourth quarter of 2024. And 2021, that was at about 25 million. So it's retained. And I think that's important too, because there's kind of a thing you hear where people will say, oh, the more you trade, the more you lose, or the more ways you have to get access to markets, the more risk you take. And it's not really the way it works necessarily. Number one is if you're a profitable trader, then you want to put on more volume. Number two is that a lot of folks are using these as ways to hedge and are ways to actually kind of reduce their vol in some sense from a big institutional perspective. But yeah, the point is that number one, since COVID, these levels have remained very elevated, but they have been trending up and to the right, and COVID was an explosion of single stock options trading relative to ETFs. That's normalized a little bit, but still, we can do all these analysis on ETFs, stock specifics, the index, and we will be doing that according to kind of the calendar of what's on the agenda as we're doing this series. We're going to be looking at specifics like we've done on our shows before, gamma levels for Tesla, NVIDIA, as well as the index level.
Absolutely. I think you nailed that. And I love that you mentioned the single names versus the index level. So this stuff didn't really blow up until those 0 DTEs, and the Monday, Wednesday, Friday was the first move SPX made in the indexes. They started offering those, and then they added Tuesday, Thursday, so now you have an expiration every day for options. Well, if we track that back and go look, this sort of phenomena of really analyzing options positions didn't start to gain traction until you had the indexes offering them every day. And now that has started to affect the market in a broader sense, whereas prior to this, if you were doing this kind of analysis, you were really mainly looking at just individual names. And this phenomena that we're seeing within positioning in the indexes having an effect on individual names wasn't as big, but now that they're trading every day and accounting for about 50% of volume most days, it's having an effect.
Let's set the table with market makers, dealers, kind of the ways we're going to refer to the big players in the market. And I would say that it's kind of a prelude to that. Everything we talk about is very agnostic in terms of kind of why people are doing things. We don't really know why. We also can't really always or really ever really assign too much causality in markets.
Nope.
But the way I think about a lot of this stuff that we're going to be talking about is kind of think about a highway. And when you have big institutional players with a lot of money at stake, to your point earlier, you kind of go where the liquidity is. So you kind of think about these levels as almost guardrails in a way, sort of on a highway that, they can bend, they can break, absolutely. They do kind of set out a general sort of path that you expect the rest of the market generally to follow. Now, these things break and they move around, and that's kind of where the fun comes in. But a lot of it is from a very agnostic perspective of just, this is where the positioning is. We don't need to think too much about why they're doing it or if it's good or if it's bad. That's just where the money is.
Absolutely. And, one thing I do want to clarify with that, too, is that it's a big sort of symbiotic relationship between market participants and the market makers. And market participants
can't have one without the other.
Right. You can't have one without the other. And market participants, it could be as simple as retail traders. It could be institutions. It could be money managers, banks. Could come in a multitude of different forms. But really, the reason why this whole gamma stuff came about, the gamma exposure and analyzing the levels, is through an understanding of the relationship that exists between market makers, dealers, and big money, and then other people in the market, that are sort of on the other side of that trade.
Right. Well, there's a whole spectrum, right, of people that are trading against each other.
Exactly. And the other thing, too, is, it's no secret. It's been this way for probably as long as markets have existed. Big money moves markets.
Right,
if Carl Icahn comes out and buys up Caesars,
sure,
like he did a couple months ago, and then Caesars takes off a month or two later, I don't look at that as a big surprise. Was it guaranteed that it would? No. But let's be real. Big money moves markets and has an impact.
Yeah.
And so understanding two main things about dealers and market makers, I think, is crucial to this sort of base before we really dive into how does this GEX stuff work. And it's simply this. Market makers serve a role by providing liquidity, right? We go to the market, we want to get a fill. Market makers on the other side fills us. And then what do they have to do? They have to go hedge their deltas. Market makers try to be delta neutral, provide liquidity, hedge their book so that everything stays balanced. They collect the spread, and wherever the market ends up going, we either make or lose, and we move on. In terms of that relationship between market participants and market makers, it isn't a bad thing.
Yeah, it's not adversarial.
No.
It's just you're in the ocean, and there are different fish of different sizes.
Right.
And there's a symbiotic relationship oftentimes by swimming in the current.
With the whale.
Which is what a lot of options traders do.
Right.
Which is you swim in the current, you pick up what's left behind. And then sometimes if there are big moves, you try and get along with it. Generally, trying to fight against it is not a profitable event. However, if and when it is, those can be highly profitable events.
Absolutely. When structure breaks down,
Correct.
and we have meltdowns and melt-ups, those are great opportunities. At the end of the day, though,
The nature of it, of course, is that vol is generally dissipating. Those things don't happen, which is
Correct.
where the analogy of kind of the guardrails, most likely, you're not going to be driving off those.
right, and it's not nefarious.
it does happen.
Right, and it's not nefarious. It's not negative. It's not like those levels that can't seem to break on a given day. It's not like, a market maker or a big institutional trader is targeting you or me or
Right,
anybody else
yeah.
in the market. It's just that.
Don't flatter yourself.
Right. If too much money, or I shouldn't say too much, but if enough money is at place at certain levels, it has an effect
Of course.
on the market in terms of what's the dealer's book look like, how are the institutions
Gravitational
positioned.
pull, basically.
Right, it's physics.
Kind of like it's kind of like a vortex, in the water. Kind of, I think, kind of pulls it in,
Magnet,
right?
Right, and then either sends it back out in the direction it came from,
Right.
or eventually it sends it out in the opposite direction, it breaks through, and it moves on to the next range.
Yeah.
But-
Magnetism. There's a lot of ways to think about
Right.
it.
And in sort of rounding up the discussion surrounding market makers is that, it's not that market makers are trying to prevent anything. That they wouldn't exist if they weren't there
Yeah.
to provide liquidity and, help the market be able to do what it does. And if they didn't exist, would you want to make a market with me?
Sure.
We don't know how
Right.
to price this stuff.
Right.
It's hard. So
That being said, of course, there's also, even though they're literally, many of them run by machinery, they're still programmed in algos. A lot of people blame things on the algos when there is a human programming it behind it.
Yeah.
So and the market, of course, by nature is sort of an organic beast that's going to put everybody to the test at one point or another, which is when you get those levies that start to break, when the dealers are offsides in an event. But those are usually high vol, low probability. Doesn't necessarily have to be a black swan, but those are the kind of tail risk style of events.
exactly. And at the end of the day,
They're not gods, basically, dealers.
right.
Nobody is.
Dealers' books can blow up, and it's not the end of the world if it does. It creates an opportunity.
Sure.
And at the end of the day, though, what we're trying to do is really just emphasize market structure and dynamics, the relationship of all the different market participants amongst each other, and then looking at options as we're seeing record high options volume and simultaneously we're seeing fairly low equity volume. It's becoming very obvious that watching options and watching volume, open interest, and gamma levels is a great tool to add to
For
the
sure.
belt.
The tail on the dog is getting quite powerful, and that's kind of where, in some ways, to me, you can also see a lot of this just by going through kind of basic technical stuff. Like, there is so much overlap I found, but that also has added credence to kind of my understanding of this as being a force, because before I even started thinking about gamma levels, I would just think about things from a purely technical perspective: wedges, support, resistance. And a lot of that forms around high volume areas. And naturally, a lot of those high volume areas are going to be driven by big dealer positioning based on where options are. So do they always overlap perfectly? No. But to see a lot of that stuff share the same levels, and then seeing price action kind of confirm that those are important levels, has kind of brought me into the fold where, okay, some of this is essentially just a fancy way of saying, prices are going up or prices are going down, but knowing kind of at what point those prices are going up and down in a surprising way is where it gets interesting, because that's when you start to get those potential for bigger events of, okay, we were supposed to have a lot of dealer pushback at this level, but we're breaking through it. Then, all right, this is getting really interesting. Where then would we go next? Well, let's look down there. And that's kind of where we get into actually calculating the stuff, which, by the way, we're going to do on here. Oh, yeah. We're going to actually go through it and show people how to do this, because the math is not super complicated. And if you have trading platforms, you can pull the information from there, because a lot of this is kind of picking up the crumbs that are left behind and doing that math to figure it out on our own.
It's taking that entry level of data that everybody has and sort of comparing the various variables to one another, and just manipulating that data in a way that adds value.
Correct.
In terms of the technicals, in terms of the gamma, in terms of how it all intertwines, it's not a coincidence. There are plenty of times, I know you've seen it, you'll have a 200-day moving average or a 50-day moving average, some major level, or a point of control relative to, volume over the past 52 weeks. And you'll see those levels that the technicals are pointing out, and then you go look at those levels via strikes and options and positioning on the front end, and you'll see there's a lot of options trading going on around those technical levels. So it almost begs the question, like, is it the technicals that drive the strikes at which the options get placed, right? So it's, again, it isn't that this is the end-all, be-all. It's all intertwined. It's very much, like you said, organic, symbiotic.
Yep.
Everything's feeding off of each other.
It's a piece of the puzzle. It's just a piece that's gotten quite a bit bigger
as
in the last 5 years. Yeah.
Index options trading has exploded, and as just market participants have increased the amount of options trading they've been doing.
Yeah.
And to me, this is relevant to the retail trader because it gives you insight into what levels you would really expect to maybe act as a magnet, act as support or resistance, or act as a foot point in the sense that, hey, this has been holding this whole time, but if it finally breaks, what's going to happen?
Yes, whatever's happening then is probably a higher conviction event.
Correct. And at that point, you might see a shift in structure. And I know we always say, too, this is one of those things, the market's dynamic. You should constantly be watching this stuff every day.
It's an input.
Exactly. And so, then going forward, now that we've sort of nailed all this down in the future, hopefully we get into, calculating GEX and gamma exposure, how to visualize those levels, and then ways to interpret it and, hopefully trade it.
We are. Thanks for tuning in to episode 1 of Gamma On. We've got a lot more ahead of us. We're going to be talking the actual calculations to figure this stuff out, going through the math, alongside some great guests and some really smart people that are going to be joining us as we connect this into the big topics that you're thinking about when you're trading. Make sure you subscribe to the Schwab Network YouTube page, and we will see you for more.